All right, quick heads up here. This is not investment advice. This is just information to get you thinking. Do your own homework, talk to your own advisors, and make sure this kind of deal makes sense for you. We're here to share ideas, not tell you what to do. Cool? Okay, cool. Welcome back to Invest in Square Feet. Today we're going to dive into something super interesting, and it's medical real estate with triple net leases. Think about dental offices, urgent care facilities, and other healthcare spaces. These investments are all about stable, predictable returns with the potential for some serious long term upside. We'll break down why these buildings are such smart investments and how triple net leases work. And we get even deeper. We go into finding out what goes into finding the right tenants. If you're an accredited investor looking for an opportunity, you're going to love this episode.
We'll buy existing dental buildings. We do more than just dental now, but we got into this through dental buildings, only veterinarian buildings, urgent care, dermatology buildings. We will sometimes buy the building while the dentist or provider is actually going to put money into retrofit it for their needs. And we will negotiate a lease simultaneous with that transaction. We will also sometimes do what's called a sales leasebacks. We'll step in, buy the building, and negotiate the lease at that time. We'll also buy medical buildings where a lease is in place, but it has to be a really good lease. To answer your question, it's probably one of the most important questions as it pertains to our business is what is a triple net lease? I've done over 100 in my career. It took me probably to do 20 to really understand the nuances. There is not a textbook answer. The summary of a triple net lease is the tenant pays all the taxes, all the maintenance, all the utilities, and virtually all the ongoing expenses of the building. It's incredible when you compare and contrast it to something like multifamily, where the landlord is on the hook for taxes or sometimes the staff on site, et cetera. In a triple net lease, the tenants, and in my world, it's medical tenants that are high margin, typically high profitable businesses, they pay everything. They pay the property taxes, the insurance, the maintenance, lawn care, shoveling snow, et cetera, of the building. And so the financial transaction, when you have a triple net lease, if you do a good job of having what I call a gold standard triple net lease, it behaves like a bond. In other words, if that medical tenant is strong and you understand what a strong medical tenant is, then that triple net lease should be paying like a dividend every month if you do the right thing and you have the right triple net lease in place and the right underwriting to really understand the tenant.
Yeah, so interesting. And obviously, so when you're acquiring these properties, do you guys go in and do the retrofit where you're putting in all of the equipment that's needed, or is that on the tenant as well?
Tenant for the equipment, even the build out on them. If they are doing a build out, we will approve the designs. I've done lots of build outs, so we want to make sure they're improving the building, but they'll actually be investing capital expenditure in the buildings we own. And it also means healthcare tenants are incredibly sticky. These are 10, 15-year leases, but the probability that they leave is very unlikely. Oftentimes they'll be putting in $500,000 in capital expenditures into the building of their own dollars. And so that creates a very sticky tenant. Obviously, it makes it a very attractive asset. If you can find the right healthcare tenant at the right price, it's the value add being on the buy side. It can be incredibly lucrative and stable.
Yeah. How does that work? So they're improving your space, and obviously the drywall and the paint and the fixtures and all of that, that's one thing, but they're putting in x-ray machines and drills and mold making machines, all of that stuff. Does that go to the value of the property, or essentially do they, if they ever leave again, let's say that they wanted to move on, they take all of that stuff with them? Is that how that typically works, or is that typically not even ever happen, really?
Equipment, if it's not plumbing or would be theirs unless they're in a default.
Hmm.
So if they're in a default, actually, we would own the business. They're guaranteeing Their business is guaranteeing. Obviously, we'll also then have a corporate guarantee, typically from a private equity sponsor. So that the event of that happening is incredibly unlikely. But if it did, anything in that building is ours. In fact, we will take over the business and keep it running.
Mm.
Very unlikely to happen. But if it did, that's one of the unique things of HealthWealth Capital. We're a bunch of healthcare operators, so we know what to do in that event. If it's end of lease and they are not in default, the equipment is theirs, that all of the build out is now the landlord. So the infrastructure that they put into what would be a gray shell space is the landlord's. For example, we're closing on a building. It's a pretty large building, 12,000 square feet. 3 tenants have now built it out for 3 different types of dental. There's a pediatric, an implant, surgical, and a general dentist. They'll have put over $1.5 million into the building. Now, it's a 15-year lease. The probability anybody defaults, and as investors, I don't plan on holding it for 15 years.
Right.
But in the event we did, that all goes to the value of the building and the landlord.
Yeah, interesting. What about you guys obviously have had exposure to a lot of different types of medical businesses, dentistry, right? Do you get involved with the call it the marketing side of things or the actual growth side of things? Is that part of this as well? Because again, I would imagine that the medical professions are just like any other business where the practitioner might know the business, but they might not necessarily know anything about getting more business. So I'm just curious if you get involved on that side of things as well to actually help them grow also.
Occasionally I offer it. I've purchased over $50 million worth of healthcare businesses. I've been a part of underwriting of well over 1,000. And we do full blown 3 years of financials underwriting
Hmm.
to the benchmarks in healthcare at such a level of granularity. You could almost put our work side by side with the quality of earnings by a third party. And our lenders actually have, complimented us that we do a better job than they do in really understanding the tenant's financials. So why do we do that? When we make a purchase decision of a building, I don't want them to call me. I will. I help. I have a passion for helping providers, but we want to have this be just a great success for our investors. And our value add is on the front end. We're actually not just buying in a good market, good looking or building in a good lease, but we know that tenant is a strong performer. So typically, if they're struggling, I might offer help, but I'm not going to buy their building
Hmm.
because I don't want to take that risk on that front. I do help. A lot of providers actually reach out to me, help on, hey, I'm thinking of partnering with a private equity backed group. And that's a pretty big journey on how to optimizing value. And I think they really appreciate it. And as a landlord, I want them to sell to a really strong buyer. I don't mind helping them. And it's also going to help out our asset to make sure a strong buyer buys them and partners with them.
Yeah, that's cool. And I want to just circle back and just touch on something real quick because you made a great point there. The way that I was thinking about this was essentially you're buying the building and you're getting it all set up for some type of medical practice to move in. And I was almost looking at this like a startup, like this is a brand new business that is going to be starting in your property. But it sounds like you will only work or you basically underwrite these properties that are very well functioning and doing very well. So I guess the risk is much less in that situation because it's not a startup. People already know what they're doing. They already have an established business. Is that right?
And they're signing a 15-year lease. So it's not taking a risk on a individual provider. This is a corporate backing on that end. So we will do those, but they've got to be super low risk,
Mhm.
meaning that this large group is guaranteeing the master lease of the building. And in that scenario, we'll sometimes do it, but they're actually doing the build out. They're doing all the design, all the work of improving the building.
Yeah, that is really interesting. It seems I'm curious from your perspective, Where are the downfalls? Like, what types of things could go wrong with this type of an operation? Obviously, it's been very successful before in the past, but
So every commercial broker will say, "Oh, this thing's a triple net lease." And so one downfall is there is not a textbook definition of a triple net lease. It probably took me 20 and actually being a tenant of one before I understood the nuances that you can get burned, either as a tenant or a landlord. And so not really having a really solid all of the features that you need in a triple net lease to protect as a landlord is one area where you can get really caught in terms of maximizing value, et cetera. The second, for example, having the right as a landlord to financials of the tenant.
Mhm.
Most people wouldn't think of that. And a lot of times they forget. If you don't have access to the financials of the tenant and you go to sell the building in 4 or 5 years, you now lost value
Mhm.
as a triple net lease holder, landlord, a ton of value. Trying to sell a triple net lease building and you don't have financials of the tenant versus when you do, massive valuation improvement. That's just one of probably 100 things we make sure are present or accounted for in a triple net lease. The second, just because they're a healthcare tenant doesn't mean they're strong. I've run healthcare businesses, have a lot of people on the boards I've run and others. Doesn't mean everybody's high performing. And so you really got to understand, is this a strong tenant? And triple net leases exist in the majority of shopping centers you go to. I mean, and it pertains to restaurants and other places. So I really understand, and my team really understands underwriting the strength of them. And in the startup, I underwrote the corporate. They gave us all the financials. So I knew their financials as good as they do. And so the strength of this is the tenant, right? If that tenant defaults, you're going to have a problem. And so that's probably the second place where things can go wrong. So it's of course, the strengths of my team. But if somebody were to start this from scratch, you got a learning curve to go through to really understand. And there are medical buildings out there for sale where the lease is bad and there are no access to the financials.
Mhm.
Uh, those aren't deals we do, but other people are maybe not as educated or whatnot. And people will chase after those opportunities thinking, oh, this is a great market. I talked to the provider. They told me they're doing really well. And so they buy the building. So anyway, those are two. The third, probably not real risk, but it happens. I have hundreds of providers that have worked for me in my previous entrepreneurial business. People die. It's sad to say, they get disabled. I built a business in Colorado and doctors like to go skiing and they break things. A problem if you're a dentist.
Yeah, yeah.
And yet providers are your revenue generation of the business. That's why about 2/3 of our building are private equity backed. Private equity, big groups, they've got a whole infrastructure to swap in a new provider, get a temporary person in. The group that I built, my track record, this happened, death, disability, injury, never had a psycho dart for more than 10 business days. You hire a for hire per diem doctor. It's not great, but it keeps the lights on and treating patients, etc. So most of that we wouldn't be called in, but occasionally, God forbid, let's say that happens, there isn't a private equity back. Let's say there's a personal guarantee by the provider. My team knows what to do. I know what to do to get somebody in there temporary if they don't have support staff that knows what to do, just to keep the lights on, revenue coming in. And we would work with a medical broker to sell the practice. The proceeds go to the heirs, but then the buyer steps into the lease and we're secure. But those are the biggies and what would happen in those scenarios.
Yep. Talk a little bit about I guess, the asset profile that you're looking for. Where are these primarily located at? Is it everywhere throughout the country, or do you have certain demographic things that you're looking for to be able to qualify that this is a good market to be able to invest in one of these? Talk a little bit about the actual asset and what you're hunting for.
Couldn't have been a better segue because of that third risk, death, disability, injury. We try to be in a populous area where you could actually call in somebody. So you're not so rural that if something were to happen to the provider, because they're the key asset, you couldn't get somebody else in there. And typically, it doesn't have to be a major metropolitan area. Typically, 50,000 people within 10 miles, there's enough providers in that kind of a community that can come in on a per diem basis in this like really worst case scenario on that front. Also, we're only going in growing markets, meaning the population needs to be growing. That's for the benefit of the tenant. Our business case is not to change the use of the building. We're not buying a dark space and trying to find a new tenant. It's mostly we just want to be where our tenant is going to do well in the market. And so we choose to be in growing or stable population growth areas. The only exception to that might be if we're in a massive 500,000 within 10 miles. And if it's decreasing just a little bit, there's enough population that for medical, they're going to be very secure. But that's more of an exception to the rule. So 50,000 or more in 10 miles and growing population than anywhere in the United States
Anywhere. Okay.
because of a triple net lease. So property management, literally one person can handle 100 buildings. And the requirements of the landlord are so light, it's more confirmatory. The tenant is on the hook. They're responsible for, even if there's a roof leak, the HVAC unit, there's these half-ton units on the ceiling. Really, the tenant is on the responsibility to fix these things. And they're running medical businesses, so they're not slouches. They want to get after it. So they're quite responsible typically to rectify any issue with the building.
So, typically, what are some of the pushbacks that a lot of investors maybe have with this type of an asset? Again, I feel like it checks all the boxes, right? Is there anything that you hear often, or a lot of things that, or a lot of times maybe people don't understand certain nuances of this?
I think that nuance that takes thinking is many accredited investors have invested in multifamily deals. And so have I, and they can be great. But oftentimes the upside in multifamily depends on things that you're going to do after you buy.
Hmm.
Renovations, increasing rent, maybe replacing the property managers. And so that investment thesis could not be more diametrically opposite than mine. And that takes some thinking. The value add in our investment thesis is all on the front end. It's the underwriting of the tenant, right? It's all on the pricing and understanding that triple net lease. So all of the work is when we do the buy.
Hmm.
Then I don't want to have, if I just want to collect rent or rent, this is mailbox money. And that nuance, I've had investors ask me, what's the value add? And then when I described it's the underwriting and the financials, it's the triple net, it's finding the right price in these opportunities, then the light bulb goes off. But it's so different because it's all on the front end. And it's not to say multifamily, you got to do all that planning on the front end, but then all the hard work after you buy the building.
Yeah.
I'm done. I'm on to the next building in our business model. And because of that, the returns are more predictable. So our distributions are monthly, 60, 90 days post close with 100%. We know with certainty what it is because it's a triple net lease. It's not a guess. There is, you could say in our base case, the downside risk is less and the base case upside is, so maybe it's a little less than multi-chain in the base case, but the upside for us in medical, there are several case studies when you pool many medical buildings together and you get to a certain net operating income, 10 million is around the number. There are several case studies that they have converted and sold or sold to a medical REIT for a 30% premium or higher.
Hmm.
And I love scaling businesses. I've done it before. Base case returns, high teens. I love that. I'm one of the biggest investors. But the opportunity to get a premium on top of that is fun to chase after. And so we're going after getting to 10 million, roughly 70 to 100 of these buildings, and selling for a premium to a medical REIT. That would put the IRRs in the high 20s, 25 to 35%. And that then goes head to head with some of the multifamily big upside
Mhm.
plays. But if I don't get the big upside, the downside risks in ours is so low, meaning it's much more predictable. 8% cash on cash distributions paid very quickly after purchase, in high teens on a base case, meaning we're just selling these off to individual buyers. And triple net leases, once you understand what they are, they're highly sought after. So people that have owned, let's say, a apartment complex and kind of manage it themselves, they commonly like to do 1031 exchanges, tax deferred sales into triple net leases. And if they can do it into a triple net lease and be medical, it's a very common thing, and that keeps the pricing and really attractive um, when you can negotiate and get these triple net leases in the medical buildings in place.
So this will be a little bit more advanced question. I'm curious here, but you mentioned the 1031 exchanges, and typically when you sell a multifamily, you have to reinvest into like kind investments. You're able to roll over again a multifamily sale into this type of an
Um,
asset.
the common disclaimer: I'm not an attorney nor your tax advisor. Seek your personal counsel, but those advisors that I've worked for have found it to be suitable
Huh.
and accommodated it. And our syndications, if it's a large enough dollar amount, that like 300, 400,000 range or higher, preferably higher,
Mhm.
we'll do the tenant in common, 1031. There's a lot more paperwork and partnership involved in those situations, but they can be very lucrative with our syndication. But then there's people that just do it outright
Mhm.
to own a triple net lease building on their own.
Yeah, that's interesting. Is there any chance that you may create your own REIT also as an exit strategy?
So I'd say the good, better, best. The best we would sell to a REIT. Reason being, it's a little quicker. Next best is we would convert. And that would mean I know what it takes to sell and roadshow a business to institutional money. And it's a very similar process. So you have to go on a roadshow with investment bankers, tell your story. And I would tell our story to convert. And then the base case is we'd sell these off in onesies between years 4 and 5. But selling to a medical REIT could be transactional, a little quicker for investors, and would be the first choice.
Mhm. Talk a little bit about your, I guess, the fund structure. Is it ongoing or is there a cap that you're trying to raise a certain amount of money for this ultimately? Talk a little bit about that.
Yeah. To date, we've done 506C, so we can market the deal opportunities to accredited investors. They're closed. They're they're not. It's not an open fund, but we are typically putting upwards of 10 to 11 medical buildings in a series.
Okay.
So an investor, let's say a credit investor makes $100,000 investment, they're going to own a piece of upwards of 10 to 12 medical buildings, all underwritten with the similar returns. When we attempt to go for our upside scenario of selling to a REIT, we will bundle all of the buildings, even the ones I've owned in my legacy funds, and we will bundle them all together to get the returns and the upside.
Yeah, that's interesting. You're bundling these into 10 to 11 funds, I guess you can say. And what is your end goal? You said, I believe you wanted to have about 100 buildings, 100 different practices, I believe. 10 different funds. Is that what the end goal is? You said, I believe you wanted to have about 100 buildings, 100 different practices, I believe. So 10 different funds. Is that what the end goal is?
Probably a little less. So it's about 10 buildings per raise, right? So series. So if an investor comes in this year, we'll likely have 3 series. So
Okay.
depending on when they invest, and each series will roughly have between 5 and 10 buildings. We're at the end of February, we'll be at about 3 million of net operating income of what we own already. 10 million is that first watermark, if you will, that we will test the market to sell to a REIT for a premium.
Got it.
We're on pace to do that in 36 months. The whole period that we're letting investors know that 5 years is on the outer side. That's if we sell these off in onesies. But that 36-month period is the sooner side converting to a REIT or selling to a REIT. And for those people that don't want the money back and they just want to keep the money rolling, selling to a REIT would allow that in some and converting to a REIT. So the ability to keep your money going to work for those investors that want to do that, I probably will be like that. Wanting to keep some of that money at work is a nice outcome.
Yeah.
So roughly, uh, we're a third of the way there in terms of having enough volume and size and, feel like we're on a good pace within 36 months. Now, if we get bigger, the better. We're at 12, 15 million in net operating income, all the better. We'll run this to get to the right size or higher in 36 months and then test the market.
Yeah. That is interesting. And from a reporting standpoint, as far as the investors are concerned, what does that look like? Again, just to set the stage for.
Yeah. So we use cash flow portal.
Okay.
Everybody can get access. It's just like having a Schwab account. You can log in. We'll do monthly distributions, about 60 to 90 days post close. Quarterly reports is what I promise. I try to over deliver. We do quarterly reports and it comes in email, but then if you missed it, it's all in the portal as well as K1s for taxes.
And K1s are delivered approximately what time of year? Is this
Knock on wood, I'm 5 for 5 last 5 years on time before April 15th. I can't promise that's always gonna happen, but I've got, uh, um, a good track record. Actually, I think I'm 7 years a row on time, but so far so good.
good?
But we certainly are on top of things with our bookkeeping on that front.
Yeah. This is really an interesting opportunity. Again, completely different than anything that I've heard of or seen before. Before we switch over to the life crafting segment, was there anything else that you wanted to mention about this at all, or did we cover it pretty well?
I think we covered the opportunity well, and if there's any listeners who wanna reach out to me, you certainly can.
Beautiful. Excellent. Okay, so let's really quickly jump over to the life crafting segment. And again, just for the listeners who might not be familiar with this, I started doing this probably almost 2 years ago now, where every Sunday I write out what my goals are for the week and I create the action steps to achieve whatever those goals might be. So, what I found out was that I was a lot of times guessing to what those action steps were to achieve those goals. And a lot of times it ended up where I didn't achieve them. So I thought I'm talking to all of these really experienced entrepreneurs, these amazing individuals. Why don't I just ask them what it is that they're doing that was having a big impact in their life? So the question that I like to ask is what is your highest ROI activity in your life, right? So again, some people go very personal where it's more meditation. Other people go business orientated and I'm doing this type of marketing strategy. So it can be all over the place. So AJ, when I ask you, what is your highest hour activity? Where does your mind go with that?
Conceptual and tactical. Tactically, learn this tip. I sell Excel spreadsheet Monday through Friday, and it's categorized into business building, culture, people, then business development, sales, investor relations. So those three buckets. And the most important bucket, and conceptually, the most important thing is business building. And so I force myself every day, typically no more than two things, oftentimes realistically one thing that, and it's first on my list every day that I'm going to get to a business building activity. And that's where I think my highest and best use is. And my definition for business building is putting something in place that's going to generate revenues or it's a system that's going to last for more than a year, that it's going to keep paying dividends when I'm not around it could be a strategic hire, or it could be some new AI tool putting in place, publishing a book that's going to be out in the ecosphere for a long time. And so that business building activity, at least one a day, before all the noise and fires come at you day to day, when I can stack those on top of each other, I've just seen the biggest leap in growing businesses in my professional career.
Yeah, I like that. And along the business building, I guess that mindset, thinking about that, do you have a certain window or a period of time that you say, okay, this is going to be designated to this activity? I'm just curious, like when you're saying you want to achieve like one thing, say you're writing a book, for instance, are you writing in that book for an hour a day, or does it depend on your schedule? I'm just curious how you go about designating the time that you're going to put toward this activity.
I'm on other boards and active in a couple different things. And so I have not found it helpful to block on my schedule. The first opening
Hmm.
is where I do the business building. So I do have a fairly busy calendar day to day, but there are openings every day, most days. In that first opening, I look at my sheet and I know right away I'm doing the business building activity. Sometimes I don't get it done. Sometimes business building is creative thinking and it's like a hard 30 minutes.
Hmm.
But it's probably the most valuable 30 minutes of my day. So that's what's worked for me. I've tried the blocking, but when I've been involved in other companies and things are going quickly, I've had a hard time sticking to that to accommodate. Even on my HealthWealth Capital team, we're all in different time zones. And the blocking was so inconvenient to accommodate various people in different time zones. So I chose not to go that route. And it's the first opening.
Got it. Got it. Okay. Yeah, interesting. And are there some days that there are no openings too, or do you make a habit to make sure that you're blocking off something each day?
Most days, but they're occasionally, especially that board meetings, those just are a little brutal.
Yep.
But most days there are openings, and generally speaking, in the mornings, I'm up incredibly early and do find time then. Although again, I have a team that's crossing multiple time zones, so occasionally that gets eaten up too. But most days.
Yeah. No, this is AJ, this has been fantastic. If people want to learn more about you or this opportunity, how would they reach out and get in touch?
Two places: healthwealth.capital is the website. And they can also email me at AJ, just the letter A, the letter J, at healthwealth.capital.
Excellent. I certainly appreciate the time today, and I think this is going to be interesting. I think we'll dig deeper into this. Maybe some of the investors out there might hear about this from us also, because I do find this really interesting.
Really appreciate it, Matt.
No problem. And that pretty well sums it up for this episode of Invest in Square Feet. Medical real estate and triple net leases are such a cool niche. Stable, consistent cash flow with the potential for big upside. We really broke down how this space works and why it's worth exploring. If this sounds like something you want to learn more about, we're currently qualifying accredited investors. Reach out to us on any of our social media channels. And one last thing, this podcast is for informational purposes only. This is not investment advice. Make sure that you do your own research, chat with your own advisors, and figure out if this type of deal is right for you. We're just here to give you ideas, not make decisions for you. Thanks for listening. Don't forget to subscribe, leave a review, and share this episode with anyone who might find it helpful. Until next time, keep building your investments 1 square foot at a time.